Hello and welcome to our video on 5 rookie mistakes to avoid when investing in your 20s. Investing is an important part of building financial security, but it's also easy to make mistakes when you're new to it. In this video, we'll share 5 common mistakes that many beginners make and show you how to avoid them. Whether you're just starting out or have been investing for a while, this video is for you. Investing is a great way to grow your money and secure your financial future. However, it's important to avoid some common mistakes that many people make when they start investing. These mistakes can be costly and set you back in your financial goals. So, whether you're just starting out or you've been investing for a while, this video is for you. We'll go over the top 5 rookie mistakes to avoid when investing in your 20s so you can make smart investment decisions and build a strong financial foundation. Mistake number 1. Investing without a plan. The first mistake that many people make is investing without a plan. When it comes to investing, it's crucial to have a clear understanding of your financial goals and how you plan to achieve them. Without a plan, you risk investing in the wrong things and missing out on opportunities that align with your long-term goals. Before you start investing, take some time to think about what you want to achieve. Do you want to save for a down payment on a house? Build up your retirement savings? Start your own business? Once you have a clear understanding of your goals, you can start developing a plan to achieve them. Your plan should include things like your investment objectives, your risk tolerance, and your time horizon. It should also outline the specific investments you plan to make and how much you plan to allocate to each. By investing with a plan, you can ensure that your investments align with your long-term goals and that you're making informed decisions based on your unique situation. So, don't make the mistake of investing without a plan. Take the time to develop a clear understanding of your financial goals and how you plan to achieve them. This will help you stay focused and disciplined as you work towards building a brighter financial future. Mistake number 2. Putting all your eggs in one basket. Another common mistake that rookie investors make is putting all their eggs in one basket. In other words, they invest all their money in a single stock or investment without diversifying their portfolio. While it can be tempting to put all your money into a hot stock that you think will take off, this is a risky strategy that could backfire. If that stock doesn't perform as well as you hope, you could lose a significant portion of your investment. On the other hand, if you spread your investments across a variety of stocks, bonds, and other assets, you can reduce your risk and increase your chances of long-term success. Diversification is key when it comes to investing. By spreading your investments across different asset classes and sectors, you can reduce your exposure to any single investment and protect yourself against market volatility. This can help you achieve more consistent returns over time and build a more resilient portfolio. So, don't make the mistake of putting all your eggs in one basket. Instead, focus on building a well-diversified portfolio that aligns with your long-term goals and risk tolerance. This will help you build a solid foundation for your financial future and achieve greater peace of mind. Mistake number 3. Following the herd mentality. One of the biggest mistakes that rookie investors make is following the herd mentality. This means that they invest in a particular stock or asset simply because everyone else is doing it without conducting their own research or analysis. While it can be tempting to jump on the bandwagon and invest in the latest trend or hot stock, this is a risky strategy that could lead to significant loss. Just because everyone else is investing in a particular stock doesn't mean it's the right choice for you. You need to conduct your own research, analyze the fundamentals of the company, and consider your own financial goals and risk tolerance before making any investment decisions. In fact, many successful investors have made their fortunes by going against the herd and investing in undervalued or overlooked stocks. By doing their own research and analysis, they were able to identify opportunities that others had overlooked and build a successful portfolio. So, don't make the mistake of following the herd mentality. Instead, conduct your own research, analyze the fundamentals of the companies you're considering, and make informed investment decisions that align with your long-term goals and risk tolerance. This will help you build a more resilient portfolio and achieve greater success over time. Mistake number 4. Failing to monitor your investments. Another mistake that rookie investors often make is failing to monitor their investments. Once they've made their initial investment, they may simply set it and forget it without regularly checking in to see how it's performing or making any necessary adjustments. However, failing to monitor your investments can be a costly mistake. Market conditions can change quickly, and even a well-performing stock or asset can experience significant declines over time. By regularly monitoring your investments, you can stay on top of any changes and make any necessary adjustments to ensure that your portfolio continues to align with your long-term goals and risk tolerance. It's also important to periodically review your investment strategy and make any necessary adjustments. As your financial goals or life circumstances change, you may need to adjust your investment approach to ensure that it continues to meet your needs. For example, if you're getting closer to retirement, you may need to shift your portfolio towards more conservative investments to protect your nest egg. So, don't make the mistake of failing to monitor your investments. Instead, make a habit of regularly checking in on your portfolio and making any necessary adjustments to ensure that it continues to align with your long-term goals and risk tolerance. This will help you achieve greater success over time and build a brighter financial future. Mistake number 5. Letting emotions drive investment decisions. The final mistake that rookie investors often make is letting their emotions drive their investment decisions. Investing can be an emotional process, and it can be tempting to make decisions based on fear, greed, or other strong emotions. However, investing based on emotions can be a costly mistake. Emotional decisions can lead to impulsive buying or selling, chasing after trends, or holding onto losing investments for too long. These decisions can lead to significant losses and undermine your long-term investment strategy. To avoid this mistake, it's important to develop a disciplined investment strategy and stick to it. This means setting clear investment goals, creating a well-diversified portfolio, and following a consistent approach to buying and selling investments. It also means being aware of your own emotional biases and taking steps to overcome them. For example, if you find yourself becoming overly anxious or fearful during a market downturn, it can be helpful to step back and review your investment strategy to ensure that it aligns with your long-term goals and risk tolerance. You may also want to consider seeking for guidance who can provide an objective perspective and help you stay on track. So, don't make the mistake of letting emotions drive your investment decisions. Instead, develop a disciplined investment strategy, stick to it, and be aware of your own emotional biases. This will help you achieve greater success over time and build a brighter financial future. Investing in your 20s versus other age groups. Now that we've explored some of the common mistakes that rookie investors make, let's take a closer look at how investing in your 20s compares to investing at other age groups. While investing at any age can help build wealth over time, there are some unique advantages to starting early in your 20s. For one, you have more time to benefit from compound interest, which means that even small contributions can grow significantly over time. Additionally, starting early can help you develop good investing habits and learn from any mistakes that you make along the way. On the other hand, investing in your 20s can also come with some unique challenges. For example, many people in their 20s may be dealing with loans, entry-level salaries, and other financial obligations that can make it difficult to save and invest. Additionally, young investors may be more prone to taking on too much risk in their portfolios or making emotional investment decisions. Comparing investing in your 20s to other age groups can help you better understand the benefits and challenges of starting early. Whether you're in your 30, 40, or beyond, it's never too late to start investing and build a brighter financial future. By avoiding common mistakes and following a disciplined investment strategy, you can achieve greater success over time and secure your financial well-being. Overcoming barriers to investing in your 20s. While investing in your 20s can have significant advantages over the long term, there are also some challenges that you may face along the way. Here are some of the most common barriers to investing in your 20s and some strategies for overcoming them. 1. Limited financial resources. Many people in their 20s are just starting out in their careers and may have limited financial resources to invest. To overcome this challenge, start by creating a budget and finding ways to reduce expenses. Even small contributions to a retirement account or investment portfolio can add up over time. 2. Lack of investment knowledge. Investing can be complex, and many young investors may lack the knowledge and experience needed to make informed decisions. To overcome this challenge, start by educating yourself about the basics of investing and seeking guidance from trusted sources such as financial content creator, books, or online resources. 3. Emotional biases. As we've discussed, emotional biases can lead to impulsive investment decisions and undermine your long-term strategy. To overcome this challenge, take steps to become more self-aware of your own emotional biases and seek out objective advice when making investment decisions. 4. Market volatility. Investing always comes with some degree of risk. and market volatility can make it challenging to stay committed to your investment strategy. To overcome this challenge, stay focused on your long-term goals and remember that investing is a marathon, not a sprint. By recognizing these challenges and developing strategies to overcome them, you can achieve greater success as a young investor and build a brighter financial future for yourself. Start early and avoid common mistakes to achieve investing success. In conclusion, investing in your 20s can be a powerful way to build long-term wealth and achieve financial security. However, it's important to avoid common mistakes and develop a disciplined investment strategy that can help you overcome the challenges of investing at a young age. By following the tips and best practices that we've discussed in this video, you can start your investing journey on the right foot and maximize your potential for success. Remember to start early, invest consistently, diversify your portfolio, and stay focused on your long-term goals. And most importantly, don't let common rookie mistakes hold you back from achieving the financial freedom and security that you deserve. So, what are you waiting for? Take action today and start investing in your future. Whether you're just starting out in your career or you're already well on your way, there's never been a better time to start building a brighter financial future for yourself. Call to action. Start investing today and take control of your financial future. If you're inspired to start investing after watching this video, we encourage you to take action today and start building a brighter financial future for yourself. Here are a few steps that you can take to get started. 1. Open a brokerage account. To start investing, you'll need to open a brokerage account with a reputable firm that offers a wide range of investment options and low fees. 2. Develop an investment strategy. Before you start investing, take some time to develop an investment strategy that aligns with your goals and risk tolerance. 3. Invest consistently. Consistency is key when it comes to investing. Make a commitment to invest a set amount of money each month or quarter and stick to your plan even when the markets are volatile. 4. Stay focused on the long term. Investing is a long-term game, and it's important to stay focused on your goals even when the markets are going through ups and downs. Remember that investing is a marathon, not a sprint. So, what are you waiting for? Start investing today and take control of your financial future. By following the tips and best practices that we've discussed in this video, you can avoid common rookie mistakes and achieve greater success as a young investor. Thanks for watching, and I look forward to seeing you in the next video.